Hey everybody, welcome to the webinar. We're going to get started in just a moment here. Want to give folks the opportunity to trickle in as they are now doing. Perfect. All right, and just a reminder that today's webinar is being recorded and you will have the opportunity to ask questions at the end of today's presentation. All right, we've got a fair number of folks trickling in. Okay. Last call, and then we are going to get started. 2, 3, 4, not anymore. All right, welcome to Azzad Asset Management's mid-year market update. Thank you everyone for being here. I'm Josh Brockwell. We'll do more formal introductions in just a moment, but let's talk about why you're here today. U.S. stock markets in 2025 thus far have experienced some pretty significant volatility, influenced by obviously major geopolitical events, some new, novel, shall we say, economic policies, and shifting investor sentiment. And while watching financial markets go up and down can be nerve-wracking, to put it mildly, keep in mind, of course, that periods of market turmoil are normal and are to be expected. That's why it's important to take that long-term view with investing, something we hammer home pretty consistently at Azzad, and obviously don't let short-term market volatility distract you from your long-term financial goals, things like retirement, wealth building, etc. We're going to talk about it at the end when we conclude, but just remember, I can't reiterate it enough, staying invested for that long haul puts you in a good position to reach your goals. And the best way to combat fear of markets is with knowledge and understanding. That is why we've asked two of Azzad's stable of portfolio managers, Christian Greiner of FM Investments and Angel Lupercio of M360, to give us their professional observations about what happened and where we might be headed in the second half of the year. So we've got folks on your screen now. You should be able to see our subject matter experts along with me. Again, I'm Josh Brockwell, Communications Director here at Azzad. I'm responsible for all things marketing and also spearhead our shareholder advocacy program. We are honored to have with us today Mr. Christian Greiner, who manages the Azzad Large Cap Growth Strategy, and Angel Lupercio, who manages the Azzad International Strategy. For those who may need a quick refresher, here's a look at who we are as a firm. For nearly 3 decades now, Azzad has been helping high-income professionals build their wealth in accordance with Islamic values. Today, we manage around $1.6 billion, as you see on your screen there, and we do that for more than 1,500 families across the United States. What makes us unlike many financial firms is the quality and nature of our advice. It's centered around you and your family, driven by a higher purpose and designed to give you or help give you peace of mind, knowing that your financial life is on track. As a reminder, we're a full-service financial planning advisory firm. Here's an overview of the services that we provide. From investment planning to tax and charitable planning to halal financial services, we have positioned ourselves as the leading provider of halal financial services in the United States. With that, let's jump into our content for today. The agenda should be on screen now. Let's turn it over to Christian for the first bullet, then we'll go to Angel, then I'll have a couple parting thoughts before we get to your questions. And very quickly, just by way of introduction, Christian Greiner, CFA, is a long-standing Azzad equity portfolio manager. He's got experience in market capitalization ranging from micro cap to large cap, holds an MBA from the University of Chicago Booth School of Business, and holds the Chartered Financial Analyst designation from the CFA Institute. Christian, take it away.
Well, thanks very much, Josh, and good afternoon, everybody. Once again, thank you for that introduction. I could go back and say, these times of market turmoil, after going through this for over 20 years, I can say they never get easier, but it is true. A little bit of knowledge does help you weather these. So with that being said, I'm happy to talk about where we stand in the U.S. equity markets after a sort of a turbulent start to this year. And what we will be watching closely here in Chicago over the next 6 to 12 months both from a big picture and a market metrics perspective. So the best place to start is really to take a step back and look at where we are as of June 30th, 2025. After all the market volatility with the start of the year, markets have posted relatively pedestrian returns. These returns that you see in front of you are for the Russell indices, except for that large blend box. That's the S&P 500 that we're all familiar with. Growth has once again outperformed value, thanks really in part to a very strong second quarter. And for the most part, large cap companies have outperformed smaller companies again. A trend that has gone back several years now and is even more pronounced if you take a look at, say, the top 50 companies by market cap. That is the 50 largest companies that are in these indices. So the bull market that we're currently in, that started in earnest coming off the inflation spike-induced lows in October 2022. And we could see an even greater disparity in returns among those market cap sizes, as well as value versus growth, if we take a look at those boxes there on the right. We came close to a bear market during this tariff sell-off during the second quarter. The S&P 500 closed as much as 19% lower from its record highs. 20% is the threshold. Usually when bull markets have these close calls with the teeth of the bear, they rally to hit new highs. And that's a phenomenon that we're seeing occur this month, though it's happening earlier than we usually see after such an occurrence. So a lot of what drove returns this year so far is what has driven returns for much of this bull market. Investors have favored stocks with perceived higher quality. Think about consistent earnings growth. They also favored companies with higher anticipated sales growth, even more than they care about anticipated earnings growth. And this is something that's relatively new, and it's a trend to watch. Those that look at valuation factors will notice that low PE stocks have started to make a comeback, albeit a choppy one, in the eyes of investors, while free cash flow yield, which is something we look at here, and that's how companies pay for investments for further growth in share buybacks, that free cash flow yield remains important, but not as much as it once was. So one of these ways that we take a look at valuations is the cyclically adjusted price earnings ratio, or Schiller PE. And I know that that's quite a mouthful. It's an interesting way of looking at the market because this really isn't a trading signal as much as it is a measure of long-term valuation risk. What you do is you consider the aggregate real earnings of the companies in a market index over the last 10 years. So in theory, you strip out market cyclicality, so the ups and downs that come from a tariff or COVID or market highs and noise like the events that we've just been experiencing over the year to year. This measure, a lot like the classic PE valuation measure, has been higher than normal for the better part of this decade, or really even the better part of this century. But partially a reflection of that lower cost of money in terms of those rock bottom interest rates that we've had for a while and are only starting to come back to normal. So what we see here from this chart is we're at kind of the top of that valuation range, levels that we last saw in 1997, 2001, which was, of course, the tech bubble, and those 10-year annualized returns. So that is the average return that you would expect to see over each year over a 10-year period. Those were roughly flat on average when we take a look at it back in time. So it's also really a helpful exercise to take a look at where the market stands on a number of valuation bases compared to history. And it's one of those things where I will tell you that valuation isn't everything. It's still an important consideration no matter where you are in the market cycle. And what we could see from all of these is that this market is not cheap on a long-term basis. The forward PE, and that is the price to earnings using earnings estimates that are looking out 1 year forward, that now stands at 22. For perspective, that was around 24 during the tech bubble. We're not at those highest levels yet, but we're getting close. We talked a little bit about the Schiller PE. It's telling a similar story. The dividend yield for the market's at a 25-year low as well, and that's sparking the usual debates of if dividends matter anymore, especially in this age of share buybacks. We touched a little bit on cash flows, and we see price cash flow is an important metric, and that's because it strips out some of the accounting distortions that we look at from earnings per share. And it tells you how much of a company has on hand really in the bank to fund new products, to invest in R&D, and to pay those dividends and those share buybacks. And the last measure here is something we like to take a look at, and that is the earnings yield minus the BAA yield. And so the earnings yield is kind of the inverse of a PE. So if a stock has a PE of 20, it has an earnings yield of about 5%. And uh, the Moody's BEA seasoned corporate bond yield is a measure of fixed income risk and return. So this is seen as really a good proxy for the attractiveness of equities versus fixed income for access to the same earnings stream. You would expect this to actually be positive most of the time, as those holding stocks are taking more risks than those holding bonds. But because of the high PEs and those rising interest rates, this is now trended to be negative and has continued to be negative here for about the last year and a half.
So, Christian, if I could just jump in here very quickly, for folks that are more sort of lay people and the uninitiated, just to do the 30,000-foot view, the level set would be these are the metrics that a professional portfolio manager such as yourself looks at to determine whether or not stocks are overpriced, underpriced, or about right. Is that safe to say?
Yeah, this is what we take a look at with the broader market to see where we are in terms of valuation during either a short term of time or a long term of time. With this, of course, we're looking at about a 30-year time horizon that goes through a couple market cycles.
Great, thanks.
So, of course, one of the themes that we have seen in financial media, specifically financial TV, is the Magnificent Seven. These seven stocks that seem to have driven market returns and captured investors' imaginations here. And they actually underperformed a bit starting this year. So this underperformance really started with one event, as you can see on this graph, and that is the announcement of DeepSeek's accomplishment in the AI space. And that casts doubt about how much AI infrastructure spending is going to be needed to be done by tech firms and others that will eventually be utilizing that technology. So these stocks sold off even harder post, Liberation Day, or the day that the tariffs were announced, because there were credible questions about demand from China and other markets for a lot of these companies. And a number of these names have since led the market higher over the last 60 days as we've marched back and hit those new highs, though a couple have company-specific issues that have caused them to lag the pack.
And sorry, one other interjection here, just for folks who are unsure. That darker blue line on the screen represents the S&P 500 index, right? That's the broader basket of 500 or so large company stocks, as mapped against the Magnificent Seven, those big mega cap tech stocks that you're talking about, right, Christian? That would be the light blue line on the.
Yes.
Okay, thanks.
Thank you. So this takes a look at it a little bit more on a granular basis here. And they say that the sequel is never as good as the original, and this time it might be true. The Magnificent Seven is starting to come apart, and what we have here seems to be a case of the good, the bad, and the ugly. And there's been even some in the financial media saying it's time to take out a couple of these names and replace them with a couple of more AI-oriented names. A couple of years ago, these names were making up over half of the total return of the S&P 500 and the Russell 1000 Growth Index. These were all positive. They all had outsized returns, and it was them and then everybody else. That influence, as you can see from this, is now less than 20%, as a number of them have negative returns on the year. And just as a note, our large cap growth strategy here at Azzad, as of 6:30, we're overweight NVIDIA. We're overweight Meta. We're have a smaller overweights in Apple and Google parent Alphabet. And we've been underweight Microsoft, and we've been underweight Tesla, and we don't own Amazon due to ethical screens. So when we take a look at this market, and we talked about the Magnificent Seven and them driving returns, this is still what we consider a top-heavy market. So when we take a look at the top 10 weights the weights of the top 10 stocks, the 10 largest weights, um, we see this relatively top-heavy nature of the large cap market. And I can attest that this phenomenon is even more pronounced in the large cap growth benchmark, which I run money against for Azzad. In the S&P 500, while these top 10 stocks contribute 21% earnings, they're now at 38% of the weight of the index, which is about the highest as we've seen in probably about 50 years. Their PEs also skew the broader market PE, though not to the degree that they once did. And so when you take a look at this and reflect on the economic value that these companies are generating, it's hard to argue their importance, and maybe some of this is warranted. However, if one goes back to the start of 2000, think about the height of the tech bubble, and you take a look at the top 10 companies back then, if you go out 25 years, only 2 of those 10 beat the broader market over the next 25 years. Those are Microsoft and Oracle, though Walmart is probably one good earnings report away from joining them. So with that being said, let's take a look at a little bit closer of what we're seeing here in the market going into earnings season. And earnings expectations have been revised lower by 4% for the S&P 500 since the tariffs were announced. And it's really been quite a spread. Software and insurance companies have actually seen a net increase in their earnings expectations here. Software has had some upgrades in terms of analyst sentiment, and insurance, well, we've all paid homeowners insurance and car insurance. But what we've also see is that autos and energy, those have succumbed to some headline risk. And these lowered expectations in certain industries and certain names illustrate that there are still some real opportunities in a top-heavy market with elevated valuations. Notice that a lot of the hardest hit industries are what we would consider more leveraged to the economic cycle. So think about autos, energy, transports, be it trains, planes, or trucks, and of course consumer durables.
I would ask a question very quickly, Christian, and maybe this is going to be answered in your next slide or upcoming comments. It seems like a little bit of a dour picture. Am I being accurate in sort of describing the first half of the year? Or maybe there's a little caution, optimism, pessimism in terms of a portfolio manager's perspective? It sounds like there are some opportunities based on this slide. Are we so is it a glass half empty, half full situation? What are we thinking?
Well, we often see these come down. A lot of times these analyst estimates are too rosy to begin with, and they come back to earth. We see that on an aggregate basis pretty much year after year. What we find interesting is when you take a look at this way, when you're taking a look at industries, which ones are being written down more than others. If you're looking for patterns, if you're looking for a reason why, if you're looking for ones that normally get written down together that don't. And then that tells you a little bit more about what to look for in the earnings season and markets. And for us, what we're looking at is really that those cyclicals are getting written down at a pretty high rate there. And part of that is, tariffs.
Got it. And that probably is a nice segue into your next slide.
It always is. So one part of this market where there may be some upside is companies that are traditionally sensitive to that economic cycle, be it consumer discretionary stocks, some industrials like those transports. These stocks usually perform better when interest rates are higher, indicating that there's some optimism about near-term economic prospects and that there's a demand for capital. Right now, real and think adjusted for inflation, interest rates are high or positive, indicating that demand for capital is still out there. However, these stocks have not outperformed defensive stocks. These cyclical stocks haven't really outperformed these defensive stocks. When I say defensive stocks, I mean things like staples, healthcare, utilities, as much as one would expect, given this historic relationship that we see on the slide here. Part of this might be the uncertainty surrounding these tariffs. With tariffs, we're still going to need food, we're still going to need healthcare, and we're still going to need to turn on the power. If this uncertainty dissipates, we could see these cyclical stocks lead the market higher, take over some of this market leadership. And so with that, we have to take a look at where the market leadership has been. And part of that, of course, has been artificial intelligence stocks. And artificial intelligence stocks saw a sell-off after the DeepSeek news was released, as we saw a few slides back. And these high beta stocks, and what I mean by high beta, I mean stocks that are really sensitive to market movement. So if the stock market goes down 1%, maybe these stocks go down 1.1%. These high beta stocks also see a steep sell-off as high beta stocks were punished during the tariff announcement date. These high beta stocks that have led the market recovery since. And while many of the that watch the market think of this phenomenon just in terms of tech stocks, this is a good time to remind our audience and investors that AI-induced demand can be seen in several sectors. You may, of course, think about the software that utilizes this, but you also must consider the hardware that goes into constructing these data centers that support the needed computational power to run AI, the industrials that create the advanced server racks and cooling systems that go into these data centers and hold these servers, the increased demand from certain utilities to power these servers, as well as the communication services stocks that are often the way that the average user, like you and me, utilizes these tools, be it through Google or be it through Meta. So farther out, the increased efficiency brought by these tools, be it from decreased labor inputs or optimized supply chains, would almost be seen in every industry group, from retail to energy exploration. There's a number of market strategists that think that this long-term increased profitability supports those lofty valuations. Think about those 22 forward PEs that we're currently experiencing. And this is a wonderful graphic from JP Morgan that illustrates this point. And this is the level of adoption from industry to industry. And this really varies greatly here. And this is, what they mention in calls and earnings calls and what they disclose. And as you expect, traditional white-collar professions are seeing quicker adoption and disruption. But almost every industry is reporting increased use of AI over the last 2 years. And that rate's going to be accelerating, as we see by the gray boxes here. This is going to be an investable theme to keep an eye on. Just as a couple of examples, Amazon has talked about how they will need less humans in their warehouses over the next 3 to 5 years. And while at the bottom there, it says, food service is one of those that really has been utilizing this. I always like to tell people, Chipotle has disclosed that its hiring AI engine has cut hiring time by 75%. And they're also testing an AI-powered robot to cook tortilla chips as well as slice avocados. This doesn't even go into the long-term possibility, of course, of self-driving cars or self-driving cargo transports, which is an exciting place to look at as well. So while we're talking about AI now, it seems like we've put inflation in the rearview mirror. And inflation was a dominant concern for US equity investors for a couple of years. And we have seen since then that the consumer price index has really come back down to those long-term averages. There's different ways of looking at inflation. And one of the simplest ways of looking at inflation that we've all heard is that it's really an increasing amount of money chasing the same amount of goods and services. And this is really what we saw post-COVID. Household savings rates spiked to 20% during COVID. We were all at home, lack of activity, and we just saved what stimulus checks or that we got. And once things reopened, that money chased those goods and services with a velocity that we really haven't seen in 20 years. Remember that phrase, revenge spending? I guess now it's revenge saving, from what I've seen in the press. Households have now burned through those excess savings. And these consumption patterns are now normalizing back to things that we are used to. And there, of course, is the fear of increased prices and hence inflation with tariffs. And as we've seen in April and May, an increase in the producer price index, which historically ends up being passed on in some factor to the consumer and shows up in the consumer price index, the CPI. This level of price uncertainty could lead to lower consumption and lower profitability, all things equal. Maybe you'll put off the purchase of a car or a dishwasher, thinking that about prices. Higher prices among stagnant or declining economic production, that eventually leads to fears over stagflation. So tariffs overall, these are seen as probably the biggest source of uncertainty for the market right now, especially over these last few months, and for good reason. Each day, we open up our browser and it brings new headlines, new threats, new deals, new deadlines, and new ways of looking at this. And while it's hard for an investor to reach a level of certainty in a company's profits, because of this, these companies themselves are really having a level of uncertainty in terms of their supply chain costs, their product offerings, and the profit margins. You see that, of course, in their earnings call transcripts, and as well as how they've either increased guidance, decreased guidance, or in some cases pulled it all together on their earnings. So these tariffs were announced on Liberation Day, April 2nd, and the global supply chain is so intricate. It was opined by trade observers that the average consumer really isn't going to feel the price increases or product shortages until the back to school season here in the US at the earliest. But the bite will be more likely in the November, December holiday shopping season, if these tariffs hold. Still, if these current levels that we've seen in the EU, Mexico, Canada, and Asian trade partners stay the same, we're looking at roughly a 15% trade weighted rate on imports in the US. And that's what we're showing here on the chart. Even if the US Court of International Trade ruling that the president exceeded his authority holds up, we're probably still looking at an increase to about 8% effective tariff rate. Still almost double of what it was over the last 3 years. And the big questions are how much of this is going to be passed on to the consumer, and how much will be absorbed by corporate profit margins, and how much this will affect those US consumption patterns. Remember, US consumption is still 70% of GDP, and how this will affect US firms, their exports, and the people that they employ.
I hear this question a lot, Christian, even addressed recently to Federal Reserve Chair Jay Powell with regard to who actually pays for the tariffs. Is it the importer? Is it the exporter? Is it the consumer? Is somebody else? Like how does that actually shake out in practical terms thus far since the Liberation Day on April 2nd?
And that is a good question, and that's something that is going to vary from industry to company to time frame. And that's one thing that we're going to be looking at here on this next slide, and that is that these tariffs, with this small sample, have been passed on to the consumer so far. And it's relatively a small sample. But so far, firms experiencing higher tariffs, be they physical goods or services, have passed on these increases to the consumer, especially in the services area. Experience says that this probably won't last. The consumer can only take so many of these increases before they become more price sensitive. And that means they start trading it down in terms of quality. Think about going from a name brand ketchup to a store brand ketchup, cutting consumption, or finding a substitute goods on these things. And that is, something that is a concern. And that is something that's going to change from industry to industry. There might be some industries where the suppliers are going to take a bigger hit. There's some where the companies that are doing the importing are going to take a smaller profit margins, and there's some where they're just going to pass it on to consumers. And that is something that is of a debate here across different industry groups. And I'll take a minute here to remind our audience that events like this not only cause very just concerns, but also investment opportunities. If companies bring back manufacturing capacity to the United States, there will be firms that benefit from this. We've already seen an increase in industrial property construction this spring. The companies that put up these buildings will be the beneficiaries. Any new factory will probably lean more on higher technology and automation to keep costs as low as possible. These industrial firms that design these machines and the software that runs them will also be beneficiaries. And these are actually one of the areas that we're looking at in our portfolio for Azzad. So, the consumer, we touched on a little bit with the tariff. Uh, let's check in with them here. And a lot has been made about the state of the U.S. consumer, and for good reason. While one could argue that the U.S. household balance sheet has never been better, as many are sitting on gains in their investment accounts, as well as rising housing values, the U.S. consumer is feeling uneasy. We see that in consumer sentiment data. And this prosperity isn't spread across to everybody. Just talk to somebody renting and looking to buy a home right now. They're having a tough time doing this. There's even a disparity in consumer sentiment around when one bought their home. So part of this consumer discomfort may have been inflation as well as uncertainty around tariffs. However, a part of it might be that the other side of the COVID equation, and that is people are finding it harder to find a job and get a raise. People talk about, it's a low firing and a low hiring environment right now. And indeed, what we see is we take a look at a measure of wage growth. And wage growth, as we've seen, has come down from 7% growth in 2022 as companies just couldn't find enough people to work post-COVID to just about 4% now. And since inflation expectations are anchored to these recent expectations of 4 to 5% inflation, that 4% raise doesn't feel like anything. These raises, they just don't feel like much. So we're starting to see the effects of higher interest rates in the consumer credit cycle starting to take effect here, so as we can see on this last chart. The percent of household income that people are paying to service their debts right now is going up. We're starting to see loan delinquencies rise a little bit, and we're also seeing consumers pull back on their credit card spending in May at a rate that surprised a lot of economists. And it wasn't just the lower 40% of income consumers that are doing this. They're seeing this across some of the higher incomes as well. So this change in consumption patterns, so far, we've seen this in terms of people trading down on certain goods and people across the income spectrum becoming more price conscious. Analysts that I followed for years refers to this as the Mercedes in the Walmart parking lot. We haven't seen this effect on travel or certain consumer durables yet, but we're going to be keeping a closer eye on the back to school shopping than in years past to see if this is really starting to take root. And one other thing to take a look at here is that while I'm happy to let my colleagues in fixed income here at FM Investments parse through the Federal Reserve statements and dot plot forecasts, I found this chart to serve as a reminder that as a market, we've really consistently underestimated how hawkish the Federal Reserve has been since the end of COVID. And when I say hawkish, I mean that they have left the Fed funds rate higher for longer than most market observers have expected. So that's just something to keep in mind as many forecast a rate cut or two towards the end of 2025. Federal Reserve Chairman Jerome Powell has expressed concerns over tariffs and their inflationary effects. And this may serve as a reason for him and the rest of the FOMC to keep interest rates higher for longer. One thing, of course, to watch is Fed Chair Powell's term. It's coming to an end in May 2026. And there's talk that a prospective replacement may be announced sooner than expected. What that would do to this level and shape of the yield curve and how that would affect equity valuations remains to be seen. All else things equal, lower interest rates are supportive of these higher PE multiples that we're currently experiencing. And so, in closing, I closed with a similar chart to this last time I did this mid-market update, and I really would like to again. So this is a chart of the S&P 500 profit margins, and this shows that management is really squeezing out as much profit per dollar of sales as they ever have. We have to take a look at where these margins are coming from, and when we take a look at the cause for profit growth, we can see that companies are more reliant on these higher profit margins than they have been in the past. and less reliant on actually growing sales. This might be a good explainer of why investors are putting that premium on sales growth that we had been talking about a little bit earlier. We also see them less reliant on share buybacks as they were in the past. With the cost of capital rising and these higher than average stock valuations, that makes some sense. So what has caused this rebound in margins? A lot of the investments that these companies made during that wage inflation post-COVID have really started to pay off in terms of reduced labor costs. We also saw, rather benign material input costs as these COVID shortages and supply chain issues have been sunsetted. And frankly, we've seen a number of companies regain market pricing power within the marketplace. So this also serves as a reminder that companies still might have some room to deal with the effects of tariffs. With those profit margins being as high as they are, they can possibly absorb a little bit of this to maintain their market share. I'd also like to remind our audience that this is for the largest companies in the US market. Smaller companies may not have such room, and their cost of capital, the cost of capital between larger companies and smaller companies, that continues to widen. So what we can see here is that the projection for earnings growth over the next few years is to be above that 7.3% long-term average. And this is what we expect for the later part of a market cycle. A lot can and will change over time as we've experienced over the last 6 months. So we'll be keeping an eye on these themes that we talked about earlier, as well as keeping our eye out for new compelling growth opportunities within the U.S. equity market.
Perfect, Christian. Thank you. Yeah, it sounds like almost a tale of two markets, to paraphrase Dickens, because it does seem like it's best of times, worst of times. We've seen all-time highs in U.S. equities, and then obviously there are some headwinds with tariffs, and I really appreciate the fact that you pointed out that we're talking at least in terms of your segment today about the large cap U.S. domestic space, because it is important for clients, investors of all stripes, to understand that there is more to the market than the S&P 500 and large cap stocks more broadly. And that brings us to Angel DiPercio. And we couldn't have had a mid-year market update without Angel here, because he is the portfolio manager of Azzad's international strategy. And if the recent tariff announcements and gyrations in the markets haven't affected his domain, I don't know what has. So Angel, thank you for being here. I'll just very quickly mention to our audience gathered here today that you are again the tenure portfolio manager of Azzad's international strategy, MBA with a concentration in finance from Olin School of Business at Washington University, Bachelor of Science in Business Administration from Rockhurst University. Angel's also a member of the CFA Society of Kansas City. Take it away, Angel.
All right, thank you for that introduction. Yeah, apologies, I was a bit late getting on, so unfortunately, I didn't get to hear everything Christian said. So if some of what I say is repetitive, apologies for that. But as you said, tariffs, of course, were sort of dominated the headlines, as you implied. So it's not surprising that international markets did well when people saw the troubles coming as a result of these tariffs and the potential for an economic slowdown in the U.S. They did geographical rotation, right? Particularly into the EU, where the ECB is actually cutting rates, and Germany launching a fiscal stimulus plan. So it was pretty clear where they should go, and go they did. Even though the US markets haven't done horribly, if you look at other markets around the world, they've actually outperformed, large markets have outperformed the United States. There was also some turmoil, and you didn't really hear about it within the fixed income space. Fixed income doesn't always make the headlines or jump out at anyone because most people think it's kind of boring. But for a nerdy guy like me, I find that kind of stuff interesting. And it was short lived, but it did give me some pause and a bit of concern. And if I start to get concerned, it's time for everyone else to get concerned, because I'm one of those guys who tends to thrive during turmoil and sort of generate returns after markets have plummeted and everyone else is sort of running around like Chicken Little, right? And then I mentioned rate cuts in other markets, primarily the EU, helped that market.
I will mention very quickly, Angel, just for folks who are attuned to the slides right now. If you're looking at the screen, you're looking at that orange line right there is the MSCI, if I'm not mistaken, All Country World Index minus the United States. So that's global stocks. If you strip out the U.S. versus the S&P 500, which Christian was talking about earlier, there's quite a delta between those two figures there.
Big
Just want
gap.
to point it out.
Yep, big gap. And then as far as sectors are concerned, it seems really odd to say financials was a risk-off play, but it actually was, along with communication services. And the reason is because these were the types of companies that would be less affected by tariffs than, say, an industrial, for example, or consumer discretionary in particular. So we only hold one financial in Visa anyway, but financials definitely was a sector that unfortunately we weren't able to take advantage of. Um, but yeah, outstanding the banks and insurance companies, particularly in Europe, Allianz, HSBC, some of the largest banks. I mean, you saw performances of some of them were up 40%, 60%. I think Santander or BBVA maybe was up like 65% or something like that. And then comm services, that one's very interesting because a lot of what drove there are two things that drove that. One of the things that drove the outperformance in the index, and it's not a huge sector, right? But was Nintendo. When they launched the Switch 2, they could not keep it on the shelves. I mean, stores were reporting selling out in 1 to 1.5 days consistently. So that drove that stock up. And Nintendo can have an effect on that single sector within the index. But also, when you think about comm services, a lot of gaming companies are in there now, right? And a lot of games are just launched online. They no longer require consoles, and Switch being, of course, an exception. So a company that many of you might be familiar with because of your children, Roblox, for example, you don't need to have anything except a powerful computer and an internet connection. That's it. And it's the most popular gaming platform probably in the world right now. But tariffs in no way affected other than economic slowdown if people can't afford to buy some of the games or stuff for their avatar within it. And then industrials actually performed well because of capital goods stocks. And much of that's going to have to do with Germany and the stimulus within the German economy. Yet keep in mind, Germany is the largest country within the Eurozone. So if industrials move in Germany, then it's pretty much going to move the index.
If I could jump back real quick, Angel, you did mention financials as being a no-go area for Azzad, and of course that is a reference to the fact that we have a screen against financial services companies. Many of our clients are going to be familiar with that already, but just wanted to reiterate that's why we weren't taking part in some of that upside.
Right. Yeah. And under normal conditions, we can overcome sort of that, if you want to call it a shortcoming, and sort of outperform. But when financials just zoom and take off the way they did, it makes it tough. We do hold Visa though. Visa's been a very great performer for us, but yeah, there are only like 3 financials maybe that will pass all the screens or something like that. But anyway, yeah. But I'm glad you pointed that out. Worst performing sectors, healthcare. This one's no surprise, and it's been in the headlines, right? Medicaid, the potential for, well, it's going to happen. Millions of people coming off Medicaid or not even being able to apply. It's going to hurt the healthcare industry in general. And a lot of, the pharmaceuticals and instruments that healthcare companies use are actually imported into the US from other areas. And it will also have an effect domestically on say retirement homes and stuff like that, because if people don't have Medicaid, many of them won't even be able to afford to do it. So there is this expectation that some of those will actually even end up just not being able to operate, probably closed down. So bad news. Anyway, that's more US based. And not surprisingly, discretionary also struggled as fears over increased costs came along with tariffs, rightfully so. I'm seeing my earnings season just got underway really, but I'm already seeing companies talking about having to pass through price increases to consumers. Helen of Troy, you may not know it, but every one of you, I guarantee you, has an Helen of Troy brand or product within your home. They own Honeywell. If anyone shops at Ulta, you walk in and you pick up, I don't know, a third of the items are probably made by Helen of Troy. And they announced that they spoke with Ultra and some of their other retailers and came to the agreement that on average, they're going to have to raise prices anywhere from 7 to 10%, and in some cases, all the way up to 15%. And so you're not only hearing about these prices being passed through, but you can see it. If you look at the CPI number, and you don't just look at the headline, you look at the core number and you strip out autos, the underlying inflation rate in this country is running, as of this most recent month, is running right around a little over 6% right now. So Things, you hear people talking about, well, inflation really hasn't taken off. It's not that bad. It is there already, and it's going to get worse, unfortunately. And then energy underperformed just because supplies grew more than expected and people expected an economic slowdown. So easy explanation there. And then best geographies. No surprise, three of those geographies are within the Eurozone. The rate cuts, which I already mentioned, of course, help fiscal stimulus in Germany. And financials and industrials, for the exact reasons I mentioned earlier, drove most of the outperformance. And this was true among most markets. It really wasn't just the EU. That's just sort of the big one. It's the largest trading bloc out there. So it's almost like you can't talk about international markets without talking about the EU a lot. Next slide. And then the worst performing geographies. No one ever really talks about Saudi Arabian financials because most people have never even heard of a Saudi Arabian financial, but they performed very well, not surprisingly. But energy utilities, energy related industrials hurt the Saudi Arabian market quite a bit. And by the way, you can see at the top there, I'm only talking about geographies that make up more than 1% of the benchmark. And then the primary culprit for underperformance in Denmark was a drop in Novo Nordisk. Denmark's a very small market, so even a drop in a company the price of a stock in a company as huge as Novo Nordisk can have a noticeable effect on the entire market. And of course, it was because Wegovy, and they've had so many copycats out there now, and including some generics that literally anyone can buy online, that it certainly hurt the stock. But I think we're at a point now where Novo can most certainly remain price competitive. So not particularly worried about the company, which we do have in the Azzad model. And then the next two slides are really busy in terms of wording, but if I'd have tried to put all this in slides like the previous, we'd ended up with 30 more slides and been here until the end of the day. So so I'll try to be brief on these so that we can get down to my favorite part, which is Q&A. So fortunately, Donald Trump has backpedaled on tariffs just left and right, and he's had no choice to do so. So the most recent effective U.S. rate now that I've seen, the estimate anyway, and it is just an estimate, is 15%. At one point, the U.S. tariff rates across the world collectively were around 30%. So that's kind of good. But as I said earlier, the impact of tariffs is already being felt, and the outlook is not good. Emerging markets performed well recently. In part, you have to keep in mind that a lot of emerging markets are like not manufacturing, mining based. And so if you have some place that produces a lot of copper, for example, that market will have performed particularly well. And with tech doing well, some of the emerging markets where there are tech companies did well. And then you also have within emerging markets, and I know this doesn't apply for us, and just sort of an explanation. Some of the most well-run banks in the entire world, believe it or not, are within emerging markets. So if financials do well, then some of those emerging markets with those huge banks are also going to do well. And then I'm sure Christian spoke about the Federal Reserve. I'll be brief. They're right to take no action here, and I just explained why with the description I gave of inflation. And then China, of course, it is. I mean, I say it's a big question mark, but it's always a question mark, right? President Xi is clearly frustrated with U.S. allies because he wanted them to fall in line and do more business with China. And and they have to some extent, but for the most part, they're just sort of holding things steady. And President Xi most certainly does not like that. And on top of that, China, they do have a bit of a real estate issue going on right now. Even though the economy is growing at 5%, there are parts of it that are not doing well at all. And then the outlook for gold and copper. There's no secret about why gold is doing so well. Central banks around the world have started buying the stuff due to geopolitical uncertainties. And something else you don't hear about is that some stable coins, asset-backed coins, actually are holding a lot of gold, billions of dollars in gold at reserves. So they're also in on the buying. And then copper, long-term outlook is great, right? With us rebuilding the energy economy, the build out of the green economy, takes a lot of copper to keep to build those turbines and all those other sorts of energy sources. And then investors sort of are starting to question the traditional reliance on U.S. assets. Definitely worth bringing that up. And that was actually it was actually worse whenever I first wrote this. Things have improved a little anyway. But a lot of the selling that you're seeing in the US dollar is because of that. But we know that it is um, it is people internationally pulling out because a lot of it's happening in the overnight market, right? When it's not trading here in the US, it's trading overnight. So if it's dropping in the overnight market, then that's an indication that the selling is coming from people outside of the US. And then I think with that, I'll just stop talking and I'd be happy to take any questions.
Thank you, Angel. Yes, we are going to get to questions in just a moment, and there are plenty of them for both of our subject matter experts who are gathered here today. Before we do that, just one quick word about investing in general. Before we get to those questions, I kind of want to put today's presentation in context for investors of all stripes. Remember, everybody gathered here today, Christian and Angel are professionals who manage your money for you. Their job is to find opportunities for you or for clients in their respective strategies. Christian with large cap growth, Angel with international. Your job is to let them do that. So one of the most frequent pieces of counsel that we offer our clients is to stay invested even when times are turbulent, to let them do their jobs. Investors forget that the cost they have to pay for potentially higher long-term returns is some of that short-term market volatility, like the kind that we saw in the first half of this year. They think that they can get in and out of markets without consequences. We've had conversations with folks like this. It's a very dangerous misconception. When you get out of markets, you'll most likely need more time, and your investments will need to work even harder for you than if you had just simply stayed put to begin with. So long story short, don't try to time the markets. No one knows the perfect time to get in and out. What a lot of investors get wrong is that equities accumulate most of their gains over just a few trading days. You can see that represented on your screen now. If you miss those trading days, you're going to be behind. We know that missing a handful of the best days over longer time periods drastically reduces the average annual return you could gain by simply holding on to your investments during market sell-offs. Avoiding the market's downs may mean missing out on the ups as well. 78% of the stock market's best days have occurred during a bear market or during the first 2 months of a bull market. If you missed the market's 10 best days over the past 30 years, your returns would have been cut in half. And missing the best 30 days would have reduced your returns by an astonishing 83%. So the lesson here is that it's time in the markets rather than timing the markets that will help you grow your wealth. So let the pros like Christian and Angel do their jobs. Once you've got a plan worked out with your Azzad financial advisor, stick with it. So now that I've said my 2 cents, let's get to questions. All right, to kick things off. Wow, this is kind of a broad one. Maybe Christian, I'll throw it over to you regarding action steps to take right now to navigate market volatility. I mean, obviously, I think that kind of relates back to my point just now about having a financial plan made in conjunction with your Azzad advisor, but maybe just we'll broaden it out and ask kind of generally your take on the volatility we've seen in the first half, and then pitching forward to the second half. Should we expect more of the same, considering that kind of push-pull of the headwinds related to tariffs, and then the tailwinds related to some of the AI that's productivity that we've not yet seen?
Well, I think that we are going to be in an environment where the market's going to be reacting to headlines much like it has been over the last 6 months. And in terms of an investment plan, one thing to consider is a lot of these companies that we're talking about here, they've managed money, they've managed their businesses through good times and bad. And when you're looking at these and you're building an investment portfolio, one thing you do look at is the quality and the tenure of management. And that's a screen that we have there for quality overall in ours. And that's something that we're going to continue to rely on here for us into what we pick. It is that kind of expertise that goes through different economic cycles. What I put there is that looks like we might be late in the economic cycle. How long that lateness is going to be, that is something that is up for debate.
Great, thank you. And Angel, let me put the same question to you, just in terms of how you as a portfolio manager navigate market volatility and kind of looking ahead to the second half. I know you kind of addressed it toward the latter half of your presentation, but just throwing it over to you for a broader comment.
Yeah, sure. My immediate response is take advantage of the volatility, right? When you see stocks that go down um, to an extent that they clearly should not, like some of the stocks that were affected by tariffs, then that's when we're going to step in and we'll either just buy outright or, in all likelihood, which is something we did just within the past couple of months, rebalance the entire portfolio. So those stocks that we have that went far down, we buy more of, and vice versa. And that's worked for us quite well over the years since 2012, I think, was when we first started working with Azzad, and then I took over in 2016, I think, or 17. And that's always worked for us to try to take advantage of that volatility.
Perfect. And maybe a follow on. I'm looking through the questions here. I mean, obviously, recent performance is an argument in favor, but I guess again, broadening it out, can you explain why international stocks should be a part of everyone's portfolio? I get the impression from some of the questions, and then hearing about client conversations, they're not always convinced. I mean, there's kind of a
Right.
home bias.
Right. Yeah. Yeah. And it's understandable. There's a home bias. I mean, that's about the best way I think you can possibly put it. But the argument for international stocks is because the international markets and U.S. markets um, aren't always substantially correlated, and that's what we're seeing right now. Right. You saw that chart where the international is just off the charts relative to the U.S. So it offers diversification. So that's one. But two, if you want to own some of the best companies in the world, the highest quality companies in the world, well, some of those aren't U.S. companies; they're outside of the U.S. Um, so, if you're a high quality manager and you can't invest both inside or outside the U.S., then you're going to have to accept the fact that some of the companies that you buy, if you want the best in the business, they're going to have to be outside of the U.S. So, one problem I think with sort of when people sort of index invest and they don't really think about it. Well, if you're buying the S&P 500, guess what? You're buying the good companies in the S&P 500, but you're also buying the worst companies in the S&P 500. So it's my job to sort of weed out those companies that aren't high quality, since we are high quality investors.
Yeah, it's a good point, and kind of a plug for active management too, which obviously pays off or can quite handsomely during periods of volatility. Christian, let me jump over to you. There is a question here related to PE ratios. We talked about them as a metric for valuation that a portfolio manager like yourself uses to determine whether or not stocks are overvalued or undervalued, if they're too cheap or expensive, to put it in other terms. This question is an interesting one, and maybe I'll also ask Angel for his input. When PE ratios are high, wouldn't it be a good idea to invest more in good markets outside the USA? What does a portfolio manager like yourself think of? And obviously putting yourself maybe in the mindset or from the perspective of an individual investor.
It is one of those when you see market valuations like that, you have to remember, of course, that PE is only one way of taking a look at the market. As I said, valuation is a big thing, but it's not the only thing. And you could take a look at the valuations in international markets, and what you will see is that they have been attractive for a while here. This has been a kind of an interesting trade to take a look at. But the other side of it, of course, is there are a lot of things to consider with a stock. Is the growth rate of those earnings? Is the growth rate of that stock that you're looking elsewhere, is it as high as, say, one in the US, or is it similar? So you take a look at that earnings growth rate, the consistency of that earnings growth, the consistency of the sales growth, and really the quality of the earnings as well. And you take a look at all of that before you're saying, I'm just going to be buying another company here or another part of the market because it's cheaper, be it here in the US or abroad, just because of that PE. You have to consider those three or four other considerations as well.
Right. Yeah, and I would agree with that. I guess the first question I always ask myself when people talk about high or low PEs is that PE only high because the company had a bad year, is going to have one bad year going forth, and then sort of from there you judge. I don't tend to use price to earnings ratio very often. In fact, even though it sounds odd in this age of technological revolution that we have, I actually pay more attention to price to book. But whenever I do a valuation for a company that goes into the portfolio, I use discounting mechanisms. So PEs are sort of iffy, and Christian's right. The growth rate is every bit as important as looking at just the PE or just the price to book or whatever, because the growth rate, which you mentioned, feeds into my discounting models. So it's clearly a consideration. So and then I would also say the other problem with P's, and I think Christian would agree with me on this, is just because a company has a P of 35 doesn't mean that it's overvalued. It could have a P of 35 because it's growing at 90% a year, in which case it probably would deserve a P that's much higher than 35. So that's a reason that I don't use comparables, looking P compared to every other company within a sector or a sub industry. But yeah, I mean, it's a great question, and it's one that I receive quite a bit. And there are a lot of aspects to it.
I appreciate that. And I think it's also instructive for us to hear both of your responses, because I think it does argue for letting you guys do your jobs, and investors focus on their financial plan, and the basic blocking and tackling of living life and financial planning. So
Right.
pros do their job, and obviously there are different strategies, different tactics, and clearly you've both shown the diversity of thought, and that's one of the great things too about having multiple portfolio managers at Azzad that we give all of our clients access to. Two of which, obviously, folks today focused on obviously featured Christian and Angel, who I think have done a masterful job. And we'll let you go in just a minute. I do want to get to one or two more questions here, cognizant that we're past an hour on the clock. This one's a little, I don't want to call it tabloidy, but obviously and it would be great to get both of your um, insights and thoughts on this. But obviously, there's been a lot of recent reporting about President Trump potentially firing or attempting to fire Federal Reserve Chair Jay Powell. And
Yeah.
whether or not that's a good idea, obviously, is one part of the question. And there's also whether or not he can actually even do it. Maybe if you could, again, I'll try to broaden it out rather than getting to the specifics of this question. Talk about the role of the Federal Reserve, maybe and interest rate policy in your respective strategies, and then maybe some general thoughts about the importance of an independent Fed. Christian, we'll start with you.
Well, I think that the last thing you mentioned there is the most important thing, and that's what we have to talk about, is that the independence of the Fed from political concerns is really a tenet of our central bank that is seen as sacrosanct across the political spectrum, as well as different economic schools of thought as well. And when that comes into question, that could cause a lot of market turmoil. And it could have effects that uh, the political operators that might be trying to remove Powell and take away the Fed's independence, uh, that would have a lot of unintended consequences. I take a look at it as that would remove a lot of confidence in the U.S. market as a relatively safe place to park your money. And over time, that would possibly lead to less investment within the U.S., a flow of capital out of the U.S., and what that would do for long-term economic returns would also probably be negative. For how I take a look at interest rates and what the Fed does for my portfolio, what I do is that I take a look at the level of interest rates, but also at the yield curve and how steep it is between the yield on, let's say, a 2-year and a 10-year. That tells me a lot about what we think in terms of economic strength in the short term and the medium term. And I make my investment decisions based upon that. Should I be going into something that is a little bit more earlier technology? Because of how that is looking, because it's cheaper for those nascent technologies to be funded. That's something for me to consider. Or because the cost of capital is so high, maybe I will flock more towards established companies that have a lower cost of borrowing and have a little bit more certainty in their project returns.
Yeah.
Angel, I'll
So
over to you.
sure. Yeah. So I guess to answer one of the questions or sort of implied question you had there, no, the president does not have the authority to fire the chair of the Federal Reserve. And It's like that for a reason. Whenever you let politicians get their hands on the money supply, it always, and I do mean always, ends up in disaster. It's the reason Zimbabwe, I think it was, correct me if I'm wrong there, Christian, had the $1 trillion bill or something like that. It's the reason
Still
Germany.
have that on my desk.
Do you?
Yes.
You know, it's the reason Germany went through a period of hyperinflation in the early part of the last century. It's just so consistent. So it has to be that way. The Federal Reserve has to remain independent. All of that said, what people seem to be forgetting and what you don't see in the headlines is that the chairman of the Federal Reserve doesn't set the policy rate. It's done by committee. Now he can influence, and he does to the best of his ability influence and try to get everyone to agree with him before they make an announcement. And in fact, Alan Greenspan was the greatest at this because they never changed the policy rate until he get everyone to agree with him. He was known for that. So even if he did have the ability to somehow figure out a way to get Powell out of office, I don't think it would change anything. Because the rest of the committee knows the period of uncertainty that we're in. And I think there is one person on the committee that said that they would be more willing to lower interest rates more in the second half. All that person was doing was trying to get a job as chair of the Federal Reserve in case Powell does get removed. I'm pretty sure that's it. As far as how we take interest rates into consideration in our strategy, I would just echo what Christian said. It's a matter of sort of the cost of capital, really the cost of debt for companies. So there are some industries where I'm okay with them having a lot of debt, even if interest rates are high, like in staples, because they generate free cash flow always, every year, consistently. Many of them did even throughout the pandemic. But then you have another industry like, say, energy, which we do have large exposure to. Well, I don't want them to have a lot of debt because as interest rates fluctuate, that's going to have a huge effect on those companies' bottom line, and as a result, a huge effect on the movement in the stocks. So, I mean, there's a lot more you could go into. That is a very broad question, but I'll end it there.
I appreciate it. Yeah,
that is
go ahead, Christian.
that is broad. And, you know, to go back to what he was saying about Greenspan, I'd also encourage people, if they're really interested in this subject, to sort of go back and listen to interviews with Paul Volcker, who was the Fed chair that brought us out of the 70s and 80s inflation. And that really tells you both the importance of a strong Fed chair, but also an independent one.
Absolutely. And it's also important because a country absolutely cannot have the people lose confidence in its currency. The world needs to have confidence that the US dollar can continue to be the world's reserve currency. So I just can't stress enough the importance of the Federal Reserve remaining independent.
Excellent. Wow. Well, I mean, we could go on, but I do think we're going to, out of respect for everyone's time, wrap things up. And I hope that people have appreciated the incredible amount of insight and expertise and market knowledge that our two subject matter experts have demonstrated today. I mean, I've certainly appreciated the conversation and the presentations, and hopefully we can do it again real soon. I do, before we conclude, want to take the opportunity to inform everyone here today about our on-demand webinars. They're available on our website, azzadasset.com. Please be on the lookout for more information about future live webinars like the one today very soon. That will conclude today's presentation. I'd like to thank all of you who took the time to be with us here live. If you'd like more information, please do reach out to us. The email address is hello@azzadasset.com. Also, be sure to follow us on social media. The handle for our Facebook and YouTube accounts is @AzzadFunds. You can find us on LinkedIn under our full name, Azzad Asset Management. Thank you both for being here today. What a wonderful discussion. Let's do it again real soon, gentlemen.
Agreed. Thank you.
So.
Thank you.